So thank you so much for joining us today, Anthony. I'm honored to have Anthony Rose, the CEO and founder of SeedLegals. I'm a big fan of Anthony and what he's doing, but I always prefer to have the guest tell their own journey and their own story rather than me kind of editing that out. So, Anthony, for those that are from a different planet and have never heard of SeedLegals, there might be a couple of people around that are in that space. Who are you? What are you doing? What's your big purpose? And what does Seed Legals actually do?
Right. So thank you so much for having me. So I'm Anthony, founder and CEO at SeedLegals. SeedLegals is a legal tech platform that if you're a founder, it's the go-to place to get investment ready and do everything you need to close your next funding round, build your team, do all the legal documents for your company. So once upon a time, people had to spend vast amounts with lawyers. It took forever. They didn't know what to do. They made lots of mistakes. And our goal is to help founders not make mistakes and get on with building their companies more efficiently. So SeedLegal's been around for 8 years now. Initially in the UK, now the US, France, Ireland, and other countries as well. We're 160 people. There are about 50,000 companies on SeedLegals. In fact, in the UK, most startups are on SeedLegals. Some investors say all startups are on SeedLegals, which is great. And now we're expanding to the US. But one of the things when we looked at the US market, one of the things I was surprised by is founders were making all these mistakes that they don't make in the UK. So the first thing I discovered, they create an LLC instead of a C-Corp and then have to spend lots of money converting it to a C-Corp. Well, they don't know about the tax savings for investors and founders, QSBS. And nobody knows about Section 1244 loss relief, which is that if you're an angel investor and you're the first $1 million in a company and the company doesn't work out, you can take up to $50,000 a year off your income tax or taxable income. So but it doesn't work if you've invested with a safe, only if you've got stock. And founders wouldn't know how YC post-money cap safes convert. So there are all these things that, because of the insane cost of legals and lawyers in the US, founders wing it themselves, Google things, download YC, safe documents. But actually, imagine if there was a solution of a modest price service of people and platform to solve that. So that's what we're doing at SeedLegals. In the UK, it has been spectacularly successful, and now we're looking to see, can we replicate the same in the US, where some things are very much the same and some things are a little different, which is fun. And lastly, these days I'm spending half my time in London and half in New York. So I flip between London and New York every 2 weeks.
So do you help companies become incorporated?
We don't do the incorporation because that's a well-defined, solution space already with Stripe Atlas, Clerky, and many others. But once you've incorporated, then we'll help you with all the legal contracts for fundraising, cap table, and the things you need to hire people for your startup. We're also about to launch an LLC to C Corp conversion product because we discovered that about a third of startups create an LLC, which is great if it's just a sole trader. But as soon as you try to raise investment, it doesn't work in an LLC. Investors don't want to have the company's tax liabilities passed through to them, and they don't get their tax reliefs that they would get if it was a C Corp. So we've now the world's first productized LLC to C Corp conversion for way less than what you'd expect to pay at a law firm. So
And but you also help raise money.
So what we do is we're not a crowdfunding platform, so we assume the founders reach out to investors themselves,
Okay.
but we help make it easier. So of course you can create a pitch page on SeedLegals and you can share that. And when investors click through to it, you collect their email address, and then where to reach out. And if they express interest, you can create a safe in like one click on the platform, and you can have your pitch deck, you can have a data room, you can have a video. And then when it comes to either creating safes or doing a priced funding round, you can do that really easily on SeedLegal. So lots of platforms lets you create safes. These are well commoditized, but uniquely what we're doing is we're productizing the price round. So previously you'd spend $40,000 to $100,000 with a law firm doing a funding round where, these are standardized documents, standardized over decades. And what we've done is we found a better, more efficient way of creating the same documents that your lawyer would create, that now founders are empowered. We take you through the deal terms. We use data to show what's market standard. We explain all the things because, founders are paranoid that their investors are going to fire them one day.
Yeah.
And, when designing your funding round documents, if you can say, these are the board seats, these are the directors, there'll be 2 directors appointed by the founders and 1 by the investor, and these are the rights. So by taking you through the deal terms and then the platform building the documents, we found that founders understand dramatically more than if their lawyer just gave them 150 pages of documents and sign this when nobody knows what they're signing. So the formula that we've created is all about empowering founders. You're driving, and on a rainy Sunday, you can create a funding round, add investors, and do all the things you need for your company. And on a model which is a SaaS model, the meter's not ticking by the hour. So one of the things, just philosophically, we live in an age, of course, where, automation and AI is replacing manual processes. But I joke with my team, we like to think, what would a law firm do? And then we'll do exactly the opposite. So we don't charge by the hour. It's always on. There's unlimited help and support. There's a chat bot. You don't need to book a call next week. The platform takes you through the deal terms, uses data to show what's market standard, builds the docs. There's a negotiator built into the platform so that, instead of emailing redlined Word docs backwards and forwards at hundreds of dollars an hour, you can say, I want this term. And 1 second later, all the docs are rebuilt. So it really is a game changer for founders. And then the question is the formula that we've created in the UK going to be a 1-for-1 match in the US, obviously changing everything to US or Delaware, typically legals. But the formula is actually very much the same. Funding round documents have been standardized. In the US, there's the NVCA, North American Venture Capital Association, and lawyers produce the same docs that we do. We just do it more efficiently.
And you said you have 50,000 companies on the platform, but you said that you don't raise the money, the entrepreneur, the founder has to raise the money, but you also have lots of angel investors. So do you distribute that to the angel investors? Hey, this deal came up?
So it's a great point. The challenge is that once you start doing matchmaking, it becomes a regulated activity in the UK with the FCA, and the US, the SEC. So we work with companies like Flipper that do matchmaking to bring investors, but rather we provide the tools for founders to make it easy. And one of the other things that we do is, apart from the things that we have as a paid platform service, we make tons of content on how to find investors, how to do LinkedIn outreach. So there's a whole sort of SeedLegals Academy of information. So there'd be a webinar or an interview with somebody who's a LinkedIn outreach expert on how to, craft a 5 or 4-step LinkedIn outreach and how to find investors. So my goal, maybe it's a bit like, instead of giving a man fish, give a man a fishing rod so he can fish, or she. So I think the idea is to empower founders. But yes, one day we may do more matchmaking, but we'll get there step by step.
And so the founder gets a link of their documents, shares that with their network, and does that network then join SeedLegals network?
Right, it's a great point. So I think you can probably put fundraising into sort of 3 buckets depending on the amount you're raising. So, let's start later stage. You're doing a Series A, you're likely to have a few lead investors that you're going to reach out to. They may send you their term sheet, you can go through the deal terms and enter it on SeedLegals. But generally, you're having a number of meetings, hope that the investor will bite. Then you take it a step back to maybe a seed round where you are reaching out to angel investors and a few funds. And then you take it even back further, a pre-seed round and family and so on. And each one is going to have a slightly different pattern. So when you go crowdfunding, which interestingly isn't that popular in the US, you're going to be raising, $500 from, hundreds of investors. When you are looking for angel investors, you can be raising, 10K to 100K checks from a dozen or a couple of dozen investors. And in that model, you're going to be doing the outreach to find those investors. So you may be reaching out to your customers, you might be doing LinkedIn outreach, you might be creating content marketing. So you're going to go find the investors, and our goal is to give you the tools to do that. And, always your lowest cost of money, so to speak, is if you find angel investors yourself. You're not paying advisors, you're not paying advisor fees to find investors. And with a VC, they want, their preference stock, they want board seats, they want all sorts of consent rights. They're going to charge you lots of money on their legal fees. So if you can find angel investors and then leverage the SeedLegals platform, we found that is not only the lowest cost of fundraising, but actually you get the most and best investor base who are, lots of smaller investors. Getting their votes and approvals is easy. They're not going to waste your money on lots of legal costs. They're not going to get together and try and oust you. They are going to be evangelists for your company and spread the word. So, angel investors, to me, is the way to go. And then, in the US, there are these two tax incentives, which strangely not everyone knows about, which is QSBS, qualified small business stock. If an investor invests in your company and it's got less than now $75 million in assets, which for most startups will be the case.
That's huge.
That's huge, I know. It was 50 million, now it's 75 million, and you're a C corporation, then the investor, if they keep their stock for 5 years, pays no federal capital gains tax when they sell their stock, which is great. And in many states, no state capital gains tax, up to the maximum or the higher of $10 million or 10x their investment.
Wow.
And interesting, you as a founder pay no federal capital gains tax if you keep your stock for 5 years, up to $10 million. So, and now with the latest changes, in fact, if you keep your stock for as little as 3 years, you'll pay only half the tax amount. So it's a great win. So when you're talking, if you're a founder listening to this and you're talking to investors, tell them about this tax savings, because it's obviously going to be significant for them. And then you're going to make sure your company qualifies. You don't need to do very much to qualify. Almost all startups will, without needing to do pretty much anything. The other tax savings, which is, so QSBS is when things go well, but not all startups go well. And of course, you want to avoid an awkward Christmas party conversation or not be invited to the Christmas party if it doesn't work out with your investor. And that's where Section 1244, the snazzily named Section 1244 loss relief comes in, which it turns out almost nobody knows about. And basically, if you're an angel investor, so someone investing personally into a company that's gone out of business, or technically your shares have gone to zero, and you are the first $1 million in the company, you can deduct up to $50,000 a year from your taxable income, or $100,000 a year if you're a joint filer. So it's a great way to mitigate your loss. And there must be hundreds of thousands of angel investors across the US who've lost money on startups that have gone out of business, and didn't know that they got a lot of money they can save from their tax. And that's something I'm working on productizing.
But the QSBS and the Section 12.4, that's only for individual. That's not for venture capitalists.
Actually, the loss relief is only for individuals, but the QSBS is for funds as well.
Oh, wow, really?
Yeah, so funds take advantage of it, and there are various tricks to even increase the effect of it. So funds might, because it's limited to $10 million or 10x the gain, um, they can create multiple separate trust entities to benefit like 10 times from that. So there are a few tricks for which later stage funds know about. But again, for early stage startups, you're mostly talking about angels, and then you're going to talk to early stage funds as well. And one of the tragedies, by the way, and where we mentor people at SeedLegals, is a common problem is founders go, I need to raise investment. I don't know any investors.
Mm.
I'm going to go do some Googling and find funds. And so they reach out to all these funds. And then the story of your life is love what you're doing, come back later. Because
Yeah,
funds, with rare exception, only invest once you've got revenue.
right.
They've got investment committees. They want to see revenue. They're not sure if it's going to work out. If you wait till you've got revenue, then they know it's going to work out. And so when they go, great, and what's your revenue? And you go, I don't have any. And you go, well, how many users? You go, I don't have any. Well, if you built it, I'm working on it. Then it's like, love what you're doing, come back later. So one of the other videos I do is decoding investor feedback. When the investor says, love what you're doing, come back later, what do they really mean? It could mean, dude, I've got no idea what you're doing. So when I see people buying it, I'll figure it out then.
Right.
Or it could mean I understand what you're doing, but I don't think technically you're ever going to be able to pull this off. So I'm just going to wait until you've done it. Or it might mean I really couldn't be asked trying to figure out what it is, so I can't understand your website messaging. So I don't think people are going to buy it. So I'll wait. But of course, none of this helps you because you need money to go build it. And so you're stuck in this catch 22. And talking to angel investors is usually the way out of that.
And most of the 50,000 startups or companies on your platform, some go bankrupt, some do IPOs, some grow. Do they ultimately leave the platform
Right.
as they
So
get
some
bigger?
Right. So some companies will outgrow the platform. They decide, great, I'm raising 20 million, I'm going to use lawyers. But they may still use us for cap table. They may use us for their option scheme. They may not use us for a funding round. And by the way, as a business, it's an interesting quandary, which is, should we service, earlier stage companies and go chase the later stage ones or not bother? But one way of looking at it is you can say, we make sports cars. If you want an SUV, go to someone who does an SUV. We make sports cars. And
Right.
but another part of me says, if somebody, outgrows us, I should have chased that business. The reality is, for every 10 startups that start, there's like one Series A. So as a business, even if some people leave us at Series A, it is not consequential because of the volume of early stage startups. My goal is, of course, to mentor all founders and startups so that they can maximally succeed and also help them spend less money on lawyers and more on software development. So,
But I would imagine that with AI becoming more prevalent, a lot of the functions, maybe not a litigation lawyer who goes to court, and that probably will not be impacted much, but a lot of the associates and those who are, cutting and pasting of previous document that they already charged somebody for will be taken over by AI because they'll probably do as good a job.
right. Well, this is one of the challenges for law firms. So if you go to a law firm and go, I've got a great AI solution for you, you can have 1/10 the number of billable hours. The
Right,
law firm will go, sorry, I
right.
did you come to the wrong door? Because we like billable hours.
Yeah.
And so there's the challenge, right? How do you sell something to a law firm that helps them be more efficient? but doesn't reduce the billable hours. And so the tragedy is, lawyers themselves, for the most part, don't like doing the drudge work. They would like to
Yeah,
automate that.
sure.
So maybe it's going to be the junior lawyers who are doing the drudge work that are out of a job, but the negotiators, the people who bring real intelligence to it,
Rainmakers, yeah.
are the ones, the rainmakers and so on, the ones playing golf and winning business. Those are definitely in a job.
Mhm.
And at SeedLegals ourselves, how do we use AI so
Right.
we can now do continuous checking of a company against the company registry to make sure that the cap table and so on SeedLegals matches your company registry. And when you do certain filings and certain things, we'll use AI to check it. So, that's the wonders of AI. But in terms of doing a funding round with AI, I don't think that's going to happen, because one of the things with AI, for the most part, is it's sort of a web chat interface. And you're not going to go, to Chat GPT and say, I'm looking to do a funding round. Great. What's your valuation? Great. How many shareholders? Enter the names of the shareholders. Okay, great. How much are they investing? Okay, now what deal terms? I mean, you're eventually going to go, this is mental. Just show me a form where I select the things.
Right.
And so, I'm not stressed about AI changing fundraising. But one of the nice things we're about to launch on SeedLegals, you can upload all your company documents and then you can query them with AI. You can say which
Oh,
stockholders have got these preference shares, or who's got, stock options, or whatever it might be. And that becomes really powerful.
you've addressed one of let in my case maybe boring, but not exciting, not sexy work of the governance and the corporate paperwork. But the biggest challenging for startups is raising the money.
Right.
Not because there's no money, there's 5 times more wealth than there is global GDP. It's just that everyone is busy being busy and not actually getting anything done. And the fundraising has become toilet cleaning, meaning that it's not fun to do, but you got to do it every day. At least some of us do. Uh,
Right.
so how are you looking at trying to address that issue? Because it's not only an issue of filtering, outreach, chasing, follow up, all of that stuff. It's filtering out the noise and finding a partner with a good cultural fit. Because it never goes according to the plan. It's always worse or better. If it's better, any investor is fine. It's worse, and they'll say, "Oh, we got to get rid of Anthony. Once we get rid of Anthony, throw him under the bus, all will be fine." Do you does Seed Legals assist or mentor or guide those startups?
Yeah, absolutely. And I think that is, a key difference between us and firstly law firms, and also, other tech platforms. We're a people plus platform. So apart from the paid services of all the legal docs, nobody wakes up in the morning and goes, I'm looking for a shareholder agreement. They wake up in the morning and go, I'm looking for investment, right?
Right.
I totally get it. So, we start with platform features like the pitch page, which gives you a URL that you can share and then tracks investor interest. And you can say,
Oh, okay.
in, out, the investor can say, I'm interested, there's a data room. So the tools to make it easier. But then also the key thing, founders, early stage founders don't know the art and craft of being a founder. So
Mm,
any astute investor, of course, is talking to lots of founders. And when they talk to a founder, they're probably deciding in the first 30 seconds whether this founder is one that they're going to bet on, so to speak.
right.
So how do you learn to walk the walk and talk the talk? And there, between founder chat groups that we've got, so you can immerse yourself, physical events that we do tons of physical events in New York and London, as well as videos and content, so you can see how you can shape your pitch deck, learn the art of storytelling, come up with wording that shows how you solve a problem, not just how clever you are. And I think one of the most valuable things as a founder is to go to physical events and meet other founders and go to pitch competitions or pitch practice sessions and watch other people pitch. Because most pitches are terrible. People stand up there, they've got a 3-minute pitch, and halfway through, they're still telling about their brother and how they have this problem. And everyone in the audience is like super stressed because they go, this is a train wreck. You can't possibly be finished in 3 minutes. Or they say, we're using blockchain and AI to transform the insurtech space. And everyone's going, I've fallen asleep already. I've no idea what you're talking about. And so, when I do pitch coaching and we do pitch practice sessions, we show how to transform that into something that says, did you know you're paying 50% more insurance each month than you should? In the next 5 minutes, thanks to our solution, you can pay half as much insurance. And now you've got the audience's attention. So it's things like that that I think help founders. And, with tens of thousands of founders on our platform who, say very nice things, that we change the way that they can fundraise. And actually, one of my favorite ones is Sophia from a bakery called Sourdough Sophia. And the bakery, she wants to raise money to make more bakeries. And she's a baker. She's not a fintech guru. She's not educated in preference shares and things like that. And she discovered SeedLegals, and I noticed her creating safes, like quite a few of them, like over 100. So I reached out to her and went, you're a fundraising machine. Can I help you? I'm the founder, by the way. I just want to know, tell me more. And I'm convinced that everyone who comes into a bakery, she says, would you like a baguette? Would you like a sourdough? And would you like a safe? And so she has leveraged the platform capabilities and the knowledge to be able to fundraise in a way she never could before. And I'm totally delighted because we're really helping democratize fundraising to not just, the MBA folks. It's so that everyone leveraging safes and, the contracts available and always on platform, a super low cost of, she can raise, $500 on a safe in minutes. And then the platform does all the arithmetic and convert them later and tells her the dilution and so on.
So a safe is like a crowdfunding mechanism?
So safes are well known in the US. So the story goes like this, which is once upon a time, the only way you could raise investment was from VC funds.
Right.
And they would invest, millions, and you'd spend hundreds of thousands on legal fees and lots of complicated documents. And that was the only way to fundraise, or you went to the bank to borrow money in between. But that didn't help you if you were a startup because you weren't going to make any money. You needed capital, and no bank was going to lend you money. And then crowdfunding arrived, so you could get small checks from lots and lots of people. And then sort of angel investment arrived, what I call the pro crowd, which is, you get a few dozen people investing 10 to 100K checks, but you've got to find those people. And so that becomes the new art of fundraising today for pre-seed and, often for seed. And then later on, of course, you're going to go to funds. And so to help founders understand what those angel investors, so for you as a founder, if you don't fundraise, you're dead. For an investor, it's a hobby, right? They could buy a new Ferrari, they could go to the movies, they could go to the Bahamas, or they can invest in a crazy startup. So how are you going to persuade them that this is going to be, beneficial financially? It's going to help save the planet or hang out with the cool kids, or going to just be plain fun, or give them bragging rights they were first into your company. So by tapping into the desires of an investor and recognizing what type of investor they are, you can now increase your investability.
So, okay, so people, so she starts a safe and someone can put in $500.
Right. So I skipped your question, what is a safe? Right. So the other thing is that the legal documents for a funding round are very expensive, and you used to have to use law firms and spend fortunes. And then Y Combinator came out with this other document, says, you know what, you can skip all this complicated legal stuff with this very simple, essentially IOU. So in a funding round, it says, I'm going to give you money and you're going to give me shares in your company stock. A safe says, I'm going to give you money And one day in the future, when you do a funding round, you're going to give me stock at that time. And to
Ah,
and to protect me, what you're going to do is you're going to give me a discount on the value of your next round, or you're going to cap the valuation. So you can say, I'm going to give you, 100K now, and you're going to give me shares sometime in the future at a valuation of no more than $5 million. So if your next round, your price funding round is at $10 million, my stock will still be as if it's at 5 million. So by coming in early, I have an advantage. And so it's a really simple agreement that has transformed fundraising in the US by kicking down the road the expensive legals. And so
kind of an
safes.
option.
So, I mean, there are convertible notes. Options, I mean, are for team members. A stock options grant is to reward team members. But generally, for early stage investments, safes have become popular. There's
Okay.
only one problem with safes. They're not really safe. So there are a few problems with safes, and I'm looking to change that. So, from an investor side, with a safe, they may not get these tax benefits, either not at all,
Uh,
or until only later when their safe converts into stock. So, this 5 year period for your QSBS tax benefits could start when you invest with a safe, or it may only start years later when your safe converts into stock. And no one really knows because the IRS hasn't ruled on it yet. So some people are hopeful that the clock starts now, and some people are being more conservative and say the clock starts later. And you can't get your loss relief if you've invested with a safe and it hasn't converted into stock. So for investors, it's a bit of like they're left holding this IOU instead of having stock. And for founders, the way the dilution stacks up with these YC post money cap safes is often a surprise to founders. If you add three investors in a round, they all dilute each other. But if you raise with three investors with safes, they all add up and dilute you. So founders don't understand often that raising with safes could actually cost the majority shareholding in their company and millions of dollars later because they're giving away more equity than had they just issued stock. So I'm working on something now called a safer that looks to solve for investors. They get
oh,
their tax
good.
benefits and they get their voting rights. And for founders, they get less dilution and usually, hopefully, happier investors and more willing investors, importantly. So stay tuned and watch that space.
I want to discuss two issues. One, in the past, I don't know, 5 or 8 years, there's been an enormous boom in accelerators, incubators, the solution to everything in your life is you have to be an entrepreneur. And I think that was a big mistake because not everyone is equipped to be an entrepreneur. It's not about genius, it's about grit. Can you get knocked down and get up regularly? Because that's really the challenge. So even though a lot of our work is helping startups raise money, we tell them all, don't raise money. Try to bootstrap as long as you can. I mean, obviously, if you're building a steel factory, okay, you can't bootstrap that unless you're a billionaire. So, I think, do you ever get in a situation, you meet somebody and this sounds really cool, and okay, you'll get your fees for your legal stuff, and you say, you know what, maybe you should not raise money, and that you sense this person is not going to be able to deal with it. You could be error. So it's that issue. And then the second, I kept hearing a lot from startups that they would meet a VC or an angel investor or a family office, and they had a great conversation. Then we would have 6 months of making out on the couch, no sex, and then they would be ghosted. And that was happening a lot. So, two things I want to cover is not everyone should be an entrepreneur, even though your business is helping entrepreneurs. And how do you filter that? And
Yeah.
secondly, how do you deal with the lack of social skills and bad actors in the VC space? It doesn't even have to be angels. It could be
Sure.
regulated,
Good.
that.
Okay. That's a great point. So let's start with, are you a founder? And this is something that I actually coach founders on, because particularly university spin-outs. So they're academics at university working on some new thing, and they think they're going to create a spin-out and then go create a startup. But at universities, you work for several years to get a PhD, which means you write a very long paper and someone gives you a high mark, which is the opposite of a startup where you ship every 2 weeks, a minimum viable profit, project, and then see how people adopt it and iterate. So my take is you should look within and see, do you love risk and do you love challenges and do you like uncertainty? And if you don't, you shouldn't be a founder. So,
Mm.
for example, the world is filled with uncertainty, tariff changes, or in the case of the UK, Brexit or COVID. And when I see people, in founder chat, in chat groups on Twitter, worried about some change, I immediately know this person's not a founder, because a founder is thinking, how can I build something to take advantage of this? Or it will affect me, regardless of whether I like it or not. What feature can I build, or how can I, get some sort of proof against it? So personally, for me, probably annoys my wife greatly, but for every perturbation in the space, so to speak, I'm always thinking there's an opportunity here. So launching SeedLegals in the US, I see people don't know about the tax benefits. Great, I can create a product for that. So, I think you should look within and you should see, not wild and uncertainty, don't like risk. Employment is great for you. Because as
Mm.
a founder, you have to take decisions with imperfect information.
Yeah.
So, probably the big one for many founders was, when COVID hit, is it everyone in the office? Is it hybrid? Is it remote? Will we ever be in the office again? Do we need to get rid of the office? Do we keep the office? Nobody knows the answer. You can't like call somebody, go, dude, what's the answer? You have to wing it. And your team has to also respect you in the morning, so to speak, because you can't just make stuff up as you go along, but you don't know the answer. So they need to see a leader. And I think these I love as the founder, that you have to take advantage of all of these, even if it's don't have the answer. So that's the first thing. And by the way, I saw some stats saying 2 decades ago, something like 2% of school leavers wanted to start their own startup, and now it's 27%. There are not 27% of people, I think, who are going to make good founders.
No.
It's more than 2%, but I think less than 27.
Right.
So somewhere there's going to be an expectation reset. So now we come to your point about, bootstrapping. So bootstrapping is you fund it yourself. Fund it yourself is great in theory. There are a few problems. One, you need to be independently wealthy. Often the best time to create a startup is when you've exited your previous startup and you've got some money. The reality is you're not going to be earning money for a while, until your first, at least, and maybe your second funding round. You have to fund it yourself. And the other thing is, when you're funding it yourself, the rate of growth of your business is limited. So that you should always, of course, start by funding it yourself. You want to validate it before you take other people's money. The other thing is, if you're funding it yourself, you put in a few grand and you decide it's not really a goer, great, just stop it. But if you've
Mm.
taken investor money and hired people, that becomes a failure, as opposed to, I'm just trying something and I got bored. So the time to raise investment money is, I think, two conditions. One, you've proved that there is a model and people are going to want it. And number two, the rate of growth for you to be able to build the business is now limited by your ability to fund it yourself. So you could say, I'll vibe code it myself and I'll do the marketing, all the sales, but your life has a value as well. If it takes another 2 years of your life because you didn't want to raise a few $100,000 to hire other people, this is a wasted opportunity. Other people are going to be building into the meantime. So once you validate it and you've built enough that you can command a valuation that lets you raise without diluting yourself too much, I think you're much better off getting other people's money. And this is a hard thing for many founders. Oh, I don't want to give away equity. But you know what? After the second or third startup, you're completely over that problem. You're much better off taking other people's money. It de-risks it for you. You grow faster. Of course, you want to pick the right time for it. And the more you can invest yourself, the later you can leave it. There is a new thing these days, a new shtick about, seed strapping. Do you maybe never need to fundraise, or you can raise a small amount of money in one round and then not have to raise again? It's a nice idea. Never tell investors that's your plan, because you just made yourself uninvestable. Because investors, there are two ways that the investments don't work out. The obvious one is the company goes bang, right? They've lost money. But the other one is the company turns into a nice company and never sells and never raises again, in which case they've got some money in this company. They're never going to get out of the company. So there's no opportunity to sell at a major new round. So investors want to see the next round, that there is a next round. So, for God's sake, don't tell them we never need to fundraise again, unless it comes with, we plan to exit in 2 years at a, 10x the current valuation. But telling them there's no exit, you're just making a nice steady state company, is nice for you. You can make some money paying yourself, but for them, it's a loss. So they're now switching to the bad actor investors. I think, there are a few websites where you can rate investors and so on. And I have to say, I thought people would rate them because they messed them around in the deal terms and with lawyers. Actually, it turns out basically 100% of the negativity with investors is they didn't return calls, they took ages on due diligence, and then they ghosted. In other words, they just stopped responding. There are a few people who are borderline fraudulent, but mostly you're just wasting your time. And, the problem is, I think, twofold. Investors get tons of incomings, so they can easily become more aloof, I think. And so the problem investors, by the way, have found is if they explain to founders why they don't want to invest in their company, it creates an angry response. So you can't say, I don't like you as individuals. I don't think you're going to succeed. I don't like your use of blockchain. All of these are going to lead to an argument with the founder. You don't understand, you're wrong, you're biased, you're racist, whatever. So investors just learn to say, love what you're doing, come back later. And that, of course, is no help to founders because they don't get real feedback. Some investors also just mess around and don't see time as valuable. And others, and probably the worst behavior, is where they're funds that don't actually have money yet. So they are playing a catch-22 game where they're trying to get some good investments potentially lined up so that they can go to investors called LPs to put money into the fund. But then they messing the founders around because they don't have any money. The founders are going, great, I'm going to close my round. And then they're now shopping around to get some money. That's really unconscionable behavior. So, I mean, how do you guard against it? Well, one, post in founder groups. Have you dealt with these investors before? Get feedback, ones that are messing founders around, very quick get outed. Number two, don't have all your eggs in one basket, shop around with many investors. And that's where angel investors, you can get 20 of them. If 2 disappear, great, just find some more. 3, start picking some deadlines like, hey, how long is this going to take? I mean, there's one fund that I spoke to that says, yeah, our due diligence is usually, 4 to 6 months. 4 to 6 months? Are you mad? The company's either grown to the next funding round or out of business by then. How can you take 4 to 6 months? The whole thing should take 4 to 6 days. So, if you're not, I mean, finding money is hard. So it's hard to walk away from a deal. But if it smells fishy, just don't bank on that investor and go elsewhere. And lastly, I suppose, investors are a bit of a herd mentality. So if they see you're popular. Ironically, the time it's easiest to raise money is when you don't need money. And
Right.
when you do need money, no one wants to give you money. So,
Yeah. And getting coming back to what you were saying about the bad actors. I mean, we created a platform for people to post positive and critical reviews, and there was actually a company that did exactly what you were saying. They were trying to raise money and they needed good deals, so they signed a term sheet with a company and they didn't have the money.
right.
That company had the term sheet and they started to spend money, and that company ultimately went bankrupt because of the commitments that were
Right.
issued. So, they posted a negative or critical review, and then it was funny, the fund came back. It's all not true. So I reached out to the CEO of the company that went bankrupt. Everything in that critical review is 100% true, and that is unconscionable behavior. But I've had many, many companies that would come back and say specifically why they said no, and they got very good reviews. So I found that size of assets had little to do with social skills. Some of the biggest ones and the most professional gave feedback right away that we're not investing in this because of this reason. But it's true, many just don't respond, and others do. But I didn't find professionality had nothing to do with size of assets.
I
So
think there's also a sort of expectation that might be mismatched on founders' side. So
yeah,
founders, I think the investors have an obligation to explain why they don't want to invest and have to put a lot of effort into explaining it. But the problem is, as I said, investors get tons of incomings.
sure.
They don't feel there's an obligation. It's like, there's a food delivery delivering all the food, and you're just going to pick one. You don't need to explain to all the other dishes why you don't like them. But so if you understand that as a founder, that the investor isn't going to spend time explaining, it's just lost, then you're not going to feel bad because you weren't looking for the. I mean, if you can get a good reason, that's great. And I must say, the investors that get good reviews are the ones that, even though they said they passed, but they passed quickly and they gave me
Yeah,
great
yeah,
feedback as to why they
exactly.
passed.
Yeah, yeah,
I would highly recommend them. And I
yeah.
think that, that's good.
How do you deal with all the pseudo billionaires? The people that, they are a billionaire, they're going to these family office events and they never seem to invest. They're always toasting champagne and they just want to be in the know or be part of the scene. Because I've never met so many so-called wealthy billionaires who have no money and never really invest. And I always tell our customers, ask three questions. Do you have money? One, do you invest in this space? And third, where? Can you give me examples of where you invested? And then call those companies to find out were they actually helpful as an investor? Because if it's going great, it's fine. Donald Trump is a good investor. If it's not going great, we got to get rid of Anthony. Then fixing, then it's problem. Do they really help you and grab the shovel to help you out?
It's a
Um,
great
y-
question, and I must say, as the Brit in the conversation, I'm always amused by the difference between British and US. The British are generally quite modest. As you talk to a founder, well, we split the atom and we're working on getting some money for it. Whereas the Americans, it's like, yeah, this is awesome. We're going to change the world with our
yeah,
blockchain thing. So I think you need to keep kind of things in perspective. But I have been surprised when I've been overawed that someone's like super wealthy. And then I'm on a call with them discussing, flights to London. They want to come and visit. And they're trying to like score a discounted ticket because they don't like the economy fare. It's like, dude, there's a mismatch here somewhere. So I think, maybe the takeaway point is I'm not telling anyone anything that's not super obvious, but, don't go by face value and don't be, overawed because the person's putting on a persona. Put it to the test, right? And don't put all your eggs in one basket as well. So
How do
yeah,
you, I mean, you have a lot of energy and I don't know if do you have children?
no,
No,
wife,
no
no
children.
kids.
Okay, so you're married and you're married to your business and you're going back and forth between New York and the UK, uh, and you're doing lots of events. I mean, online, offline, lots. How do you? Because you seem to be very energetic and you still look quite healthy. So either you're a vegan and then you're in the gym 6 hours a day, or something, or good genes. What is your secret?
It's a good point. I think, well, firstly, luck plays a large part in things. I think, secondly, it's a marathon, not a sprint. So, in the initial stages of any startup, you get really frustrated. You're not shipping this and everything has to be
Yeah.
done tomorrow. And eventually you realize, you're just going to kill yourself if you do that. So, you're going to do the best job you can every day. Make sure you get enough sleep. I like to get 7 hours and 15 minutes of sleep. Uh, the other thing is, with very rare exception, always want to have dinner with my wife. That's like a rule number one for a happy marriage. Don't
Excellent.
do evening events and so on. Dinner with the wife, and make dinner together. Uh, and then I think my day, I go to bed really late and I listen to music between like 10 p.m. and 2 a.m. And I love that while I get through emails and do kind of real work. And then my days, the whack-a-mole between Slack, WhatsApp, LinkedIn, emails, and so on. So, and I think it's just naturally a sunny disposition. I think also I love running to meetings. So I think in New York, I've got a reputation of the British guy who runs around. My apartment's near Wall Street, but if
Oh,
there's a
I grew up over
Flatiron
there.
or Tribeca or something, meeting, I'll just run there and then run back again.
Mhm.
So that's how you combine some exercise with a busy day. Otherwise,
I used to live there. I lived on Gold Street
right?
next
Yeah,
to
yeah, I
Fulton
know that.
Street.
Yeah, yeah.
So we moved there in '69. So I know the area really, really, really well. So what is your big purpose? Do you have a big purpose? You don't seem to
I should,
be
I should, I
money
should.
driven.
I don't tell my investors. No,
We can
hey,
cut that out.
even though I'm in the investment business,
Sure.
actually money means very little to me. I think
Yeah.
my most treasured possessions are, wife, and everything else can fit on a hard drive. You don't really
Right.
need much more, and a nice set of headphones and some
Right.
good music. So money doesn't at all drive me. I think what's interesting is this is my third foray into disruption. So years ago, I used to be with Kazaa, the music file sharing company. Um, and, in the time when people bought CDs and was transitioning to the internet and, building new distribution systems. And then I used to head up BBC iPlayer, the UK's
Oh, wow,
version of,
really?
Hulu, and uh, and then built a startup around social TV. And that was all about disrupting stuff that you were seeing on your TV. Now you're going to get on your phone, and it won't be TV programming; it will be TikTok. And now with legals, it's about disrupting law firms. So what's in common? What's in common is, I mean, the video, music, and law are very different. But what's in common is, as a founder, I just love taking a problem and building a solution for it. And
Mm.
then what you do is you fall in love with the way that your customers love what you've built, and you become obsessed with building something that helps them. So in the startup space, there are tens of thousands of founders who depend on our platform to build their businesses. And when I see them in chat groups or the messages or the feedback they leave and so on, it really is very nice. And then you get obsessed about building something for them. And I think, to me, that's the driver. One day there might be some new venture. I have no idea what it'll be, but
But you seem to enjoy what you're doing.
yeah, absolutely. I wish there were more hours in the day, but I very much enjoy it. Yes.
How can we, those who are listening to this when we post it, help you?
Well, that's super kind. Thank you. So, firstly, for any founder, I hope that SeedLegals is a great solution to a lot of the things you need around fundraising. So, go check out the platform. If there are any questions you got, check me out on LinkedIn, Anthony Rose on LinkedIn. I'm always try super hard to help everyone who messages me. Far too many people ask me for, can you review my pitch deck? Well, that's not really scalable, but I try. So all the things that as a startup founder, you need help with at Seed Legals, we've probably got the platform or videos or articles that cover the things you want to do because we've seen it all. And so I would love to help those people. For anyone, how you might help me, I would just say use my platform for your next funding round. That would be a great help. So, yes.
And we've spoken only about startups or early stage. What about established companies that the kids don't want to take over the company? It's a family business, or the founder wants, I've had enough, I want to sell, to a M&A
Sure.
company that is Seed Legals good for that?
They've generally got different problem spaces. So, early stage founders, it's all about optimistic fundraising,
Yeah.
growth, scale, and changing the world. Later stage companies, it's about taxes, the things in different states, exits. It's a different formula. And also, you're talking to different people in the companies. As founders, there's a certain formula. You want to change the world, time's important. For a company that's been around for 20 years, they're not going to get these tax benefits. You're not talking to the
No, no,
founder.
no,
You're
for
talking
sure.
about
It's
a hired
they want to
CEO. And
stop. They want to stop.
yeah, so there are platforms for those kind of businesses. I mean, sometimes it's just tax and accounting,
Ah,
but
okay.
for exits, there are companies like Flipper, FLIPPA, or Acquire.com. And if you want to sell your company, particularly, the sort of couple of $1 million where those platforms are about right. And by the way, it could be a new trend that people build small companies
Yeah.
to exit rapidly, influencers and vibe coding and things
Yeah.
like that. That could be a growth trend. You don't have to keep fundraising forever. You can look to flip. So, yeah, I mean, our space is around typically earlier stage companies fundraising. We may look to expand into other spaces, but actually one of the things you realize is that you can build things easily, but marketing them, you start targeting different audiences, and then your
Right.
marketing message is different. So, and then it becomes challenging doing more than one thing for different audiences.
This has been a joy, actually, and I promise to try to keep it to 60 minutes. So we went over just a few minutes over. I'm very impressed with what you're doing, how you're doing it, the integrity and straightforwardness and straight shooter. When I sent a couple of companies, you came back very quickly. This is not for us, for this particular reason. So I admire what you're doing, and if there's anything that we can do to help you, this has been actually a joy, and hopefully people will learn a lot. I didn't know anything about all those tax benefits,
Yeah.
those systems of QSBS and the Section 1244. So thank you so much. Let me just stop the recording.